In this week's Property Insider Chat, Dr. Andrew Wilson and I explore a topic close to the heart of most property investors, homeowners and economic enthusiasts, and that's how well the Reserve Bank has been taking control of our inflation, our economy, and what its effects on the property market have been considering the 13 interest rate rises. If you want to hear what's likely to be ahead for interest rates and for our housing markets, watch this week's Property Insider Chat. But before you do that, if you don't already, why not subscribe to this YouTube channel and click the little bell icon so we can update you each time a new show comes out. In this week's Property Insider Chat with Dr. Andrew Wilson, I want to explore the topic that's on the mind of every property investor, homeowner and economic enthusiast, and that's the role of the Reserve Bank in our dynamic property markets. In recent times, we've seen the Reserve Bank take some bold steps, but are these moves truly hitting the mark? Now, that's the big question. The Reserve Bank, with its mandate to ensure financial stability, employment and economic prosperity, it's been juggling interest rate decisions, inflation control, and a post-pandemic economic recovery. However, despite its best efforts, there's growing sentiment that they might not really be succeeding as well as we'd hoped. Why is this the case? Well, are the traditional levers of monetary policy losing their effectiveness, or are there other underlying factors at play? These are among the questions I want to ask Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market. Hi, Andrew.
Yes, good day, Michael, and it's been an interesting week. We've been able to digest the minutes from the most recent Reserve Bank meeting, and they're certainly very concerning, particularly the consistency that the Reserve Bank has discussed its failure to meet its forecasts. And I think that's really the theme here is the Reserve Bank's got it wrong, and it's almost made a habit of getting it wrong over recent years, and perhaps that's fundamentally why we're going to see a different Reserve Bank next year. It's also why we're going to see more interest rate increases, I believe, because we certainly, and we discussed this, Michael, the Reserve Bank went into pause mode way too soon. And the proof of that is now that we have another interest rate increase following 5 pauses over 6 months. The prospects are that we may even get another one in December. But certainly there's been no sign of an easing in economic activity to justify the pauses that the Reserve Bank has put into monetary policy since May. And it just makes it even harder for inflation to be controlled because we've put our foot on the brake and then we've taken our foot off the brake. And in a roaring economy, all that means is basically you're putting your foot back on the accelerator.
Well, every time we talk about the roaring economy, I have to remind viewers that, yes, there are a lot of Australians hurting, higher cost of living, higher interest rates, higher petrol prices, higher mortgage rates. But if you actually look at retail spending, jobs creation, business expenditure, our economy's pretty strong, isn't it, Andrew?
Oh, it's as strong as it's ever been in terms of the labour market, Michael. And now we're seeing that's wages growth reflecting how strong the labour market is. As we discussed last week, the latest wage index from the ABS has reported a record surge over the past year. Wages are now rising higher than they've risen in our history in terms of that ABS series, up by 4% over the year. And over the quarter, over the September quarter, was up by 1.3%, which is a very strong result. But we shouldn't be surprised, given the shortage of labour in the economy. Employees are bidding up their wages. The reason we haven't seen it as strong as this prior to the latest data is because we have a different or a unique wage setting system in this country whereby we have annual or even 2 yearly wage reviews. So it takes some time for the energy in the labour market to work its way through into changes in wages. But changes in wages, it certainly is driving at the moment. But look, also to your point about, yes, some people are doing it tough. And obviously with 13 interest rate rises since May last year, of course, that's fertile ground for household budgets struggling to make ends meet. Even with that record 4% growth in annual wages, we still have underlying inflation rising at 5.5%. Real wages are falling by 1.5% a year. And this is one of the worst results of advanced economies. We're not doing well at all in terms of our battle to control inflation. And this is nothing to do with what's happening overseas in a sense, which have all been struggling with higher inflation as a result of all those COVID stimulus packages. But it's a result of the Reserve Bank to some degree being seduced by thinking that higher rates in the background were working when clearly they weren't. And the evidence was everywhere that the economy was still roaring along. And it was only the fact that we started to see inflation rising again that brought the Reserve Bank back into play. But, it's belated. All we have to do is look at the comparisons with particularly the US. If we're making comparisons with overseas and saying, well, it's something that's happening internationally, the US official rate is at 5.5%. Ours is at 4.35. So our official rate is a full percent below the US rate, and yet our inflation rate is more than 1% below the US rate. So we have a lower interest rate and higher inflation, which is logical in terms of saying that we haven't had enough restriction on our economic performance through higher rates to quell inflation, similar to how it's at least looking to be under a bit more control, particularly in the US.
Well, Andrew, all of this, of course, is because we're wanting to bring down inflation. And when you look at what the causes of inflation are, it's not as clear. The Reserve Bank says it's related to local factors, but our Prime Minister, Anthony Albanese, says, oh, no, not our fault at all here. It's all related to what's happening overseas. What are your thoughts?
Well, we're moving into an election cycle, aren't we, Michael, which is going to be very difficult for all these jurisdictions that are still confronting higher inflation and higher interest rates. So I guess there has to be some sort of spin put on it. But there's no doubt that inflation essentially was driven by the COVID stimulus packages that all economies were part of, and that was fair enough. We were in a very uncertain period. We needed to sustain our economies. So we threw everything but the kitchen sink at the issue, particularly fiscal policy, and that was fine. So there were plenty of handouts, and of course that meant plenty of spending. But the problem was that we didn't have enough supply to keep up with all that demand. So logically, of course, and predictably, inflation began to rise. But that inflationary outbreak was always going to be a product of the roadblocks from supply to demand. And once that eased, which we've seen ease over the last 12 months, inflation would start to come back. And it has come back, and largely come back because of the matching more closely of supply and demand. Now we've moved through the surge from demand from those COVID stimulus packages. But Australia has its own unique problems in terms of inflation, Michael, particularly house building costs, which are typically also a problem in other similar advanced economies. But of course, we have some real problems with house building costs as a result of the previous government's home builder policy, which really produced way too much demand. And we've seen skyrocketing house building costs, which is a significant part of inflation. And the other part that the housing costs contribute to inflation are rental costs. And we've had a significant outbreak in rental costs as well, which does reflect the underbuilding that's gone on in this country really for the best part of a decade, which reflects really questionable government policies, red tape, green tape, and exacerbated now by higher house building costs. So look, these are sort of unique factors to Australia. Certainly the magnitude of them is unique to Australia. But the easing in inflation recently, really, in most economies has been because the price of oil has been falling. The dollar value per barrel of oil was as high as $124 last year, and it's now back to just over $70. So, of course, that's had an impact on the inflation rate. So we're really yet to see, in my opinion, the impact on demand from higher interest rates, really anywhere. US, Western Europe, and Australia. I think there's more to come if we want to curb demand. And of course, we're now at the end of November. Black Friday sales are everywhere. And the latest data out of the US says that they're having record retail sales in the US. And some commentators were obviously trying to talk down interest rates by saying that they expected to see a decline in sales levels, retail sales levels. Well, they've been proven to be wrong again. And we shouldn't be surprised at all the mistakes that are made from particularly market commentators, because there are agendas at play there. But yet retail sales are still very strong through the Black Friday, November sales period. So really we have no signs that higher interest rates have worked on quelling demand. And that has to mean more rate rises are to come, which of course is not good news for consumers. But this is the problem, that we can't be providing good news for consumers when we're trying to tackle high inflation. It unfortunately has to be bad news, because what we're wanting to do is actually see higher unemployment levels and reduce spending. And it's going to be those last few percent that's going to be the hardest to tackle to get inflation back to that 2 to 3% target. So it's just concerning that, once again, even in respect to the international experience, Australia's Reserve Bank has certainly underperformed versus other similar central bank policy.
Well, one of the things it was trying to do is quell inflation. And while it has come down, as you say, it hasn't come down anywhere near as much or as quickly as the Reserve Bank had hoped. It was also hoping to increase unemployment, another way of slowing down our economy. But unemployment rates haven't risen like expected. In fact, we're creating more jobs than ever.
Well, there's just been no sign that the plan of the Reserve Bank to reduce demand and therefore reduce inflation has had any success at all. And we just have to read the text, the latest minutes from the Reserve Bank from the November meeting, where they've conceded just about every factor was different to what they expected. It's almost an embarrassment to read. They stated that underlying inflation was stronger than expected, that demand pressures in the economy have been stronger than expected. They said that inflation was expected to decline at a more gradual pace, so slower than previously expected. The outlook for growth has been revised upwards and is now higher than expected. They said that this was partly because of stronger than expected population growth. Well, I think we really knew that we were going to get a surge in migration. That's been on the cards for the best part of 2 years. And they said there's been more strength in private and public investment than had previously been expected. I mean, that word expected appears, numerous times in their text. They also said that retail sales data suggested that spending has held up better than had been expected. And the Reserve Bank's been telling us for meeting after meeting that they had seen all these signs that consumer spending was falling. Well, where are they? Now they're conceding, well, those signs were obviously not accurate and that retail sales are holding up better than expected. And of course, we've been saying that, Michael, here for months, that there was no sign of an easing in retail sales data, even though the trend had eased. It was still at the levels of a year ago where we had an absolute surge in spending because of those stimulus packages from COVID. It also said that the forecast rise in the unemployment rate had been more gradual than had previously been expected. Well, there has been no rise in the unemployment rate. No. So certainly that's an issue. They also said that the outlook for wages, and these minutes were actually released before the ABS released their latest wage index data, but the Reserve Bank said that the outlook for wages growth had been revised a little lower in the near term based on the signal from timely indicators. Well, I'm sorry, RBA, but we've just had ABS tell us that we've had a record year for wages growth and a record quarter for wages growth. So they've got that one wrong again. And whatever this signal that they're getting from timely indicators is, they've got to start looking at some different indicators, I think, Michael. And they also said it would take longer than expected to bring demand and supply into balance. So really, this is just a raft of concessions that the Reserve Bank had got it wrong in terms of what they've been using to base their monetary policy on. And of course, we had the same issue with the previous governor, whose forecasts were all over the place and who's no longer there. And again, it just continues these problems that the Reserve Bank has. And of course, we know it's being completely reshuffled next year. Let's hope it makes a difference to their performance, which really has been woeful. And as we're seeing again now, through these concessions of all their forecasting and background to monetary policy has been wrong, that their expectations haven't been met in all these areas. And what I just finally, Michael, found also a little confronting was the fact that there was a number of mentions in the minutes, which was unusual, to the word staff. When they were looking at forecasts and positions on the economy, they were reflecting that these were coming from staff. In fact, it was mentioned 7 times and it was only mentioned once, that word, in the October minutes. And to me, that smacks acts of shifting responsibility for what has been these problems that the Reserve Bank's had with meeting its targets. But anyway, we move forward and hopefully we'll have a better outcome. But unfortunately, Michael, I think it does mean that because we've, in a sense, taken our eye off the ball with interest rates, we're going to have more interest rate increases down the track, even just to catch up with the US. If we're just tracking, as the Prime Minister says, the environment in the US, well, I'm sorry, Prime Minister, it does mean more interest rate increases to come.
Well, as you say, we seem out of sync with similar economies. Our Reserve Bank has been behind the curve. It's grappling with an economy that's performing much better than it was expecting to or hoping for. I guess the underlying currents are stronger than the Reserve Bank was expecting. So we'll be regularly reporting on that. I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of this new property cycle. If you think about it, the opportunity like this to get set at the beginning of a new property cycle doesn't happen very often. So why not have an obligation-free chat with my team at Metropole to discuss your goals and to discuss your options? We're much more than just another buyer's agent. We help you safely create intergenerational wealth through property. We're big enough to tip the scales in your favour, but still small enough to care. And as we don't sell any properties, our advice is independent and unbiased. Now remember, property investment's a process. It's not an event. So you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a new home, go to metropole.com.au and have a chat with our multi-award winning team. It's a great feeling having the team at Metropole on your side, levelling the playing field. But let's have a look at our property markets, which each week we discuss what's happened with auction results.
Yes.
It's the end of the spring season.
Yes.
Lots more properties have been going to auction this spring than last year. And that's understandable because we were coming out of a quiet period of 2022 when the markets were still finding their feet. How did the auction markets perform over the weekend, Andrew?
Well, the trend remains the same, Michael. We've had typically higher listings and lower clearance rates as we ended spring at the weekend, which was the last, of course, Saturday auction day for the spring season. We've still got 3 weekends left of activity until the spring selling season concludes at the end of this year. But no surprise, again, generally lower clearance rates, another big weekend of auctions, and that'll likely continue over the next couple of weekends. When we look at the capital breakdowns, big weekend in Sydney, year high numbers of auctions, 914 auctions, Michael. And the clearance rate was actually a little higher in Sydney at the weekend compared to the previous weekend, 68.3%, and still tracking above where the market was a year ago, but certainly a lot more auctions being conducted. In Melbourne, another big weekend in Melbourne, 1,019 auctions. The clearance rate's down a little bit, 62.3% versus 64.5% the previous weekend. And the same weekend last year, clearance rate just a little bit lower, percent lower than the same weekend last year, but 200 more auctions were conducted compared to the same time last year. So certainly a lot more supply there, and part of the reason of that easing clearance rate. Brisbane also had a big weekend of auctions, 102 auctions. The clearance rate's down a little bit in Brisbane, but we know Brisbane tends to be a little atypical in terms of its auction culture. Adelaide, over 100 auctions in Adelaide. Adelaide's been tracking below its 80% benchmarks over the past few weekends, but still a good result for sellers generally with 73.6% despite those higher numbers of auctions. And Canberra, steady in terms of the clearance rate, but 51.9% clearance rate in Canberra. And it certainly has been an underperformer of the major auction markets over the year to date, and well below where it was a year ago. But we can see when we look at the trends for clearance rates, that clearance rates have certainly eased since the end of autumn and into June, into winter, where they were very strong in all capital city markets, but still representing reasonable value given the volumes for sellers, given the volumes in the marketplace. I thought it was interesting, Michael, if we actually look at sales, if we look at the actual sales being conducted, so we can see that there's still very strong volumes of sales. Over November, Sydney recorded 2,425 auction sales, which was actually higher than October. Not as high as September, but well above, almost 50% above the sales that were recorded in November last year, Michael. So that tells you how far the market's travelled. 1,800 weekend auction sales in November last year, Michael, and 2,400 this year. Sydney market's still holding up quite strongly, and plenty of turnover still happening there. Big numbers of auctions or properties being sold. Melbourne also is tracking higher than where it was a year ago, but not by as much as the Sydney market. In fact, the Melbourne market really has been a relative underperform, but still 2,200 sales recorded in Melbourne, which was below the 2,800 recorded over October. But of course, October, we had the Super Saturday events occurring in October. So there were big volumes there. And of course, that meant fewer volumes through November with the Melbourne Cup holiday period. Brisbane similarly tracking above where it was a year ago, down a little bit on the last couple of months in terms of auction sales. Adelaide well ahead of where it's been over the last few months, so it's continued to track higher. But interestingly, it's around about where it was a year ago. But Adelaide's probably been one of the most resilient of our housing markets through this higher interest rate period, but still sales volumes are rising in Adelaide and remain above where they were a year ago, but not at the same increase as we've seen in particularly that Sydney market. And Canberra, underperformer Canberra, down over the last couple of months in terms of the number of auction sales. And auction sales in Canberra over November, 168 auction sales versus 208 a year ago, Michael. So I think that really validates what we've said about that Canberra market being an underperformer compared to the other capital city markets.
Well, if you look back, because you keep comparing to a year ago, where we were a year ago, yes, very few people would have believed that overall most of our housing markets would have performed so well in a year of rising interest rates and other economic challenges. Now, in a couple of days' time, it'll be the end of the month, and I look forward to catching up with you on the 30th of this month for our end of month report to see how our housing markets performed over spring. That'll give us a chance to get a good indication of not just auction results, obviously, but what's happening to house prices, units and rents. But a quick summary shows that really, boy, have they performed very strongly, much better than most had predicted. But may I give a quick plug? You actually, this time last year, saw rising asking prices before values started rising number of auctions, rising auction clearance rates. They were all forward indicators predicting a good 2023. So let's hope your predictions for 2024 will be just as powerful.
I'm not sure we're going to get the same results, Michael. We've sort of had the catch-up market, but I do think we'll have a positive year again next year. Still value in the market. I think the Melbourne market still offers good value going forward. A little bit of an underperformer compared to others this year, the other major capitals this year. But, as we head now to the end of the year, Michael, it's probably a really good time for buyers because there is more stock on market, more choices, and there's more competition between sellers who will be keen to sell their properties before Christmas occurs or arrives. So some good buying opportunities out there. And we're seeing the numbers of sales occur are still very high in most of our capital city markets. So buyers are taking advantage of that. And I think that any of those that are looking at those lower clearance rates as an indication that markets have some sort of fundamental softening would need to look at the sales numbers to understand that it's still a very heady market, particularly the Sydney market, still motoring along quite nicely, thank you. And I think when we do get that sales data out, we'll continue to see prices growth in most markets.
Well, some of the property bears are out again saying we're going to have a bad year next year, but that tends to happen around this time of the year. Just look at how their predictions turned out last year. Now, I don't think you and I are suggesting by any means the market's going to give double-digit growth in 2024. It can't. It's played catch-up now. Affordability and interest rates are going to be an issue. But people are still going to get married and have babies and get divorced and move on with their lives. People are still going to buy houses, upgrade, right size, and the market's going to continue on. And there is still a significant undersupply of rental and housing accommodation.
Yeah, and look, Mike, all we have to do is look at that 4% increase in wages, That's the fuel to pay higher prices, obviously, when you get your loan, if your wages are rising. And it's about personal household budgets in relation to general price problems. But that 4% increase in wages, which we may exceed when we get the December quarter data in terms of the next wage index, is a positive for prices growth. And I also believe, Michael, and here's a bit of a left field prediction, that we may see governments start to think about seriously offering private sector investors more incentives to get into the market. I think that's the only real workable solution to our terrible rental environment, and that's to start thinking about, I mean, we already have some very good incentives for private sector investors, capital gains discounts, tax depreciation, negative gearing. We have all these in play already. And surely if we want more rental properties, the way to do that in an environment where 40% of our stock is private sector rentals, that we offering some incentives, because we're not going to be able to build our way out of this, Michael. That's just not going to happen. We need to really start looking at incentivizing more private sector investors. And as I said, we already have the policies in place to be able to manipulate to encourage more people to come into the market. And look, next year we're going to see higher yields as we continue to see rents rising, I believe, faster than prices next year. So I think that's all very positive for certainly another resilient year in our housing markets next year.
Well, we'll be back each week discussing it. Every Saturday evening, you report the auction results on your LinkedIn profile, and I report your results on Property Update. We'll be back in a couple of days' time for our end of month November quarter market update. Thanks, Andrew.
Thank you very much, Michael.